to Iron Financial, the only place where we forge stronger portfolios by stress testing the market's biggest stories. I'm your lead analyst. Today, we are putting Zebra Technologies directly under the microscope. They just dropped their Q4 earnings and, well, the market reacted with a massive double-digit vote of confidence.
Yeah, but, here at Iron Financial, we don't just follow the herd off the cliff. We look at the blueprints, we kick the tires, we test the materials, and we figure out if the whole structure is actually sound. I'm the market skeptic, and my job is to ask the one question we're all here to answer today. Is Zebra an ironclad opportunity, or is this just a flashy facade built on pure, unadulterated hype? Let's get into it.
Okay, let's just dive right in. The very first thing that has to grab your attention is this number right here. We're talking about a surge of over 15% in pre-market trading. Look, this isn't just a little bump. This is a rocket launch. This is the market literally screaming its approval. When you see a gap up of this magnitude, it's not retail traders. It means the big institutional money is piling in, completely convinced that the future is incredibly bright. The market saw those headline numbers and, in a split second, priced in a future of explosive growth and profitability. On the surface, this signals just incredible strength. It suggests Wall Street believes Zebra's foundation is solid as a rock, and that the company is building a skyscraper, not some rickety shack. I mean, this is the kind of powerful momentum that traders dream of, a crystal clear sign that the company is firing on all cylinders. Whoa, hold on a minute. A 15% jump is impressive, I'll give you that, but it's also a massive, flashing warning sign to me. That's the market getting high on the headlines. It's a sugar rush from a really good press release, and we all know what happens after a sugar rush, right? You crash. My job is to ask the tough questions. Is this real, sustainable strength, or is it just market euphoria? Because when a stock moves this fast, this far, it almost always outruns its own fundamentals. And that creates a really dangerous gap between perception and cold, hard reality. We have to look past that initial wave of excitement and actually get in there and inspect the core structure. Are we really looking at a foundation of solid steel and reinforced concrete? Or are there hairline cracks already forming that could completely shatter under the slightest bit of pressure? That's what this entire deep dive is all about, putting Zebra through the full Iron Financial stress test.
Exactly. And to do that, we've structured our analysis into a rigorous 6-part stress test. We've already felt the post-earnings power surge. Next, we're going to step into the forge and hammer out the top line, deconstructing the revenue performance. Then, we'll move on to stress testing the very foundation by putting its balance sheet and cash flow under extreme pressure.
And after that, we'll take a hard look at the blueprint for the future to see if their grand strategic vision actually holds water.
But no analysis is complete until we go looking for the cracks in the armor. That's where we'll expose the hidden risks and dig into the numbers they really don't want you to see. And finally, after all that, we'll deliver the iron verdict. So let's begin.
All right, let's get right into the forge and look at the raw materials of this earnings report, the top line numbers. This is exactly where that initial strength, where that 15% pop comes from. The market saw these figures and got extremely excited. And looking at it from 30,000 feet, it's pretty easy to see why. The company presented a picture of incredibly robust growth and absolutely flawless execution. They hit their targets, they signaled a very strong end to the year. I mean, these are the kinds of metrics that build institutional confidence and drive stock prices into the stratosphere.
Now, what's really interesting when you dig into this slide is the sheer execution. Just look at these numbers. Net sales came in strong at nearly $1.5 billion. That's a very healthy 10.6% increase year over year. I mean, that's solid double-digit growth. They didn't just meet, they beat Wall Street's revenue forecast, and their non-GAAP earnings per share of $4.33 matched expectations perfectly, right on the money, all while still growing over 8%. From a high level, this looks like a perfectly well-oiled machine. They're growing the top line at a powerful pace, and they're translating that directly into solid earnings growth. This is the story they sold to the street, and the market clearly bought every single word of it.
Okay, but this is exactly where I have to step in and hit the brakes. A 10.6% growth rate looks fantastic on a headline, it really does. But you have to ask the critical question. Where did that growth actually come from? Was it forged from the fire of their core business, or was it just bolted on after the fact? And this chart right here, this brilliantly illustrates the problem. The real story, the one that really matters for the long-term health of this company, is hiding in that second bar.
organic sales growth was only 2.5%. That is a massive, massive gap. We are talking about a difference of over 8 percentage points between the shiny headline number and what their actual fundamental business produced. That's not a small discrepancy, my friends. That is a chasm. So, the crucial point is this. The heavy lifting here wasn't done by Zebra's core operations. Not at all. It was done by their checkbook. The company went on a shopping spree and spent over $1.3 billion on acquisitions, primarily two companies called EloTouch and Photoneo. These new assets that they bought are responsible for about 8 points of that 10.6% growth. Now look, acquisitions can be a perfectly valid strategy for growth, but this level of reliance on them, it raises a very serious, very fundamental question. Is the core business completely stalling out? Are they buying growth because they simply can't build it internally anymore? It strongly suggests the underlying structure might be significantly weaker than the polished exterior they're showing to Wall Street.
And you know, that brings us directly to the foundation. An impressive top line is great, but it has to be supported by a rock-solid balance sheet. This is where you separate the real contenders from the pretenders. So, is the company generating enough raw cash to support its big ambitions? Is the management team confident enough to actually put their money where their mouth is? And, critically, is its debt load manageable, or is it a ticking time bomb? We need to look at the main load-bearing columns of this company, the cash flow, the shareholder returns, and the debt leverage, to see if this structure can truly handle the weight of its own growth.
Okay, let's start with the engine room, free cash flow. This is what really truly matters at the end of the day. For the full year, Zebra generated a massive $831 million in free cash. Now, this is not a trivial number. This is the sign of a powerful, cash-generating machine. This cash is the absolute lifeblood of the company. It's what funds the acquisitions you were just talking about, it pays down debt, and it allows them to return capital directly to shareholders, which is what we all want to see. A strong free cash flow number like this demonstrates supreme operational efficiency, and it's one of the most solid pillars you can possibly find in a company's foundation. It proves they can convert their paper profits into actual cold hard cash, which is the ultimate sign of a healthy, thriving business.
And this right here brilliantly illustrates what they're doing with all that cash. The board just authorized an additional $1 billion share buyback, bringing the total authorization to over $1.1 billion. Let me be clear. This is a massive statement of confidence from the people who know the business best, the management team and the board of directors. They are essentially shouting from the rooftops that they believe their own stock is the absolute best investment they can possibly make with their capital. They've already been aggressively buying back shares, and this new authorization signals they intend to continue rewarding shareholders in a big way. For investors, this is an incredibly strong, bullish signal about their belief in future value creation.
Finally, let's look at the debt load. Now, with all the billions they're spending on acquisitions, you might expect the balance sheet to be over-leveraged and creaking under the strain. But their debt-to-EBITDA leverage ratio is a very, very modest 2.0x. This is a highly manageable level. It means the company isn't straining under the weight of its obligations. In fact, it has plenty of financial flexibility for future moves, whatever they may be. And get this, they have over $1 billion in unused credit capacity just sitting there. So from this angle, the foundation appears rock solid. Strong cash flow, confident management returning capital, and a debt structure that is far, far from dangerous. But see, this is exactly where the stress test reveals a critical, fundamental flaw, a crack right down the middle of that so-called rock-solid foundation. It might look solid from a distance, but the question is it being used effectively? This is where we find a major problem. The company's return on invested capital, or ROIC, is 9.79%. Now, that number on its own doesn't mean much, right? Not until you compare it to their weighted average cost of capital, or WACC, which is basically the average rate of return it needs to generate for all its investors. And here's the punchline. Zebra's ROIC is below its WACC. In simple terms, this means for every single dollar the company invests, whether it's from debt or from shareholders like you, it's actually generating less than $1's worth of value in return. It's like spending $1 to build something that's only worth 98 cents. This is a fundamental sign of inefficient capital use, and it directly calls into question whether those expensive, multi-billion-dollar acquisitions are actually creating any shareholder value at all, or if they're just slowly destroying it. Okay, so we're definitely getting a conflicting picture here. On one hand, you have strong headline numbers. On the other, weak organic growth, solid cash flow, but serious questions around how efficiently they're deploying their capital. So let's move on and see how this thing is being built by looking at their blueprint for the future. You know, every great structure starts with a plan. This is where investors are really placing their bets. The big question, Is Zebra's strategy a blueprint for a dominant skyscraper in the tech landscape? Or is it just a speculative house of cards, built on buzzwords and a whole lot of hope? The blueprint is built on three very high-tech, very high-growth pillars: artificial intelligence, RFID, and machine vision. They're positioning themselves to be the undisputed leader in digitizing what they call the front line of business. So think of retail stores, warehouses, manufacturing floors. They've launched a new Frontline AI Suite. They're projecting high double-digit growth in their RFID business, and they expect their machine vision segment to return to strong growth this year. This is a very forward-looking strategy that targets some of the hottest and most lucrative sectors in all of technology. Their goal is to own the entire workflow, from capturing the data to delivering AI-driven insights. And this is what that blueprint actually looks like in the real world. This isn't just some abstract technology or another bullet point on a PowerPoint deck. This slide shows their machine vision systems right there on a manufacturing line, identifying and starting parcels, ensuring quality, and eliminating those costly bottlenecks in real time. This is the absolute core of their value proposition, using advanced technology to make physical workflows smarter, faster, and way more efficient. They are embedding their solutions deep into the critical operations of their customers, from logistics giants to major retailers, making themselves practically indispensable. And management's ambition here is crystal clear. The CEO, Bill Burns, he puts it plainly. They aim to be the leading AI solutions provider for the frontline. I mean, this is not a modest goal. This is a declaration that they intend to completely dominate the space. Their argument is that to make AI work in the real world, you first have to give every physical asset a digital voice through their scanners and RFID tags. Then you deliver the AI's insights to workers through their mobile devices. They see themselves as the essential, absolutely non-negotiable bridge between the physical and the digital worlds. And that all sounds fantastic. It really does. But is it real? Or is it just a perfectly crafted narrative designed for an investor presentation? The CEO's quote is powerful, I'll give him that, but their new Frontline AI Suite is still in its infancy. The source material mentions paid pilots already underway, with scaled deployments expected this year. Expected is not the same as delivered. And pilots are certainly not the same as profits. How much revenue is this AI suite actually generating right now, today? Is this a tangible growth engine, or are they just slapping the AI buzzword, the hottest term on Wall Street, on everything to pump up the stock while the technology is still being tested in a lab somewhere? That right there is the billion-dollar question. And that very skepticism leads us directly to the most critical part of our stress test: exposing the cracks in the armor. So far, we've seen a very shiny exterior, but with some very serious foundational questions. Now we're going to look underneath the surface, at the numbers the company doesn't put in the headlines of their press releases. This is where the true health of a business is almost always revealed. This slide right here is probably the single biggest red flag in the entire report. On the right, you see the number they want you to focus on: non-GAAP net income, which grew a respectable 5.3%. Okay. But on the left, you see the reality, according to generally accepted accounting principles, or GAAP. Real, official, by-the-book profit. Didn't just fail to grow, it completely collapsed. GAAP net income fell by over 57% year over year. This is a staggering disconnect. One number tells a story of steady, respectable growth, and the other tells a story of a business whose profitability has just fallen off a cliff. Now, to be fair, most tech companies use non-GAAP adjustments, but a nearly 63-point gap? Come on, that's not an adjustment, that's a completely different reality. So what in the world explains this chasm between their story and the actual reality? Well, the company wants you to just ignore $76 million in what they call exit and restructuring charges. This isn't just some small accounting adjustment. This is real money being spent to shut down entire parts of their business, including their much-hyped robotics division, and to lay off workers. But just stripping these supposedly one-time costs out of the equation, they can magically report a positive non-GAAP number. But these costs are very, very real, and they paint a picture of a company undergoing painful changes and shutting down failed ventures, which directly contradicts the narrative of seamless, powerful growth they're trying to sell. And beyond the accounting games, there are some serious external and internal pressures that are building up. Management themselves identified major headwinds from volatile memory component pricing, which could seriously squeeze their margins down the line. The supply chain remains a key vulnerability for them. The broader macroeconomy could easily pressure their customers to cut back on spending. And while they talk a big game about AI and RFID, the competition in those sectors is absolutely fierce. But maybe most telling of all is a little data point buried deep in the analysis. Their 3-year revenue growth rate is actually negative, at minus 2.8%. That tells you that despite this recent pop from acquisitions, the longer-term trend for this business has been one of contraction, not expansion.
So we've run the stress test, we've examined the top line, we've pressure tested the foundation, we've reviewed the blueprint, and the skeptic has definitely exposed some pretty significant cracks. We're left with two very, very different stories here. One is of a forward-looking tech leader poised to dominate its industry, and the other is of a company with fundamental weaknesses that's just papering over the cracks. Now it's time to weigh all the evidence and deliver the iron verdict. Is this an opportunity to forge, or is it a trap you need to avoid?
All right, let's lay it all out on the table. The bull case, which is the one the market is clearly buying into right now, is built entirely on the future. Management is guiding for strong 9 to 13% sales growth in 2026. They're projecting another year of massive free cash flow, at least $900 million. They're aggressively returning that cash to shareholders with that huge $1.1 billion buyback program. And they're positioning themselves as a clear leader in the high-growth fields of AI and RFID. This is a story of powerful forward momentum.
But the bear case is rooted in the harsh reality of today. That impressive growth is being bought, not built, and it's masking an anemic 2.5% organic growth rate. While they're happy to talk about their non-GAAP profits, their actual real-world GAAP profits have collapsed by over 57%. They're inefficiently deploying their capital, actively destroying value with an ROIC that is below their cost of capital. And they are facing significant headwinds while spending tens of millions on restructuring a business that they claim is booming. This is a story of a very, very shaky foundation.
So that leaves us with this final critical question. Zebra is selling an ambitious vision of an AI-powered future, a vision that the market has clearly bought into lock, stock, and barrel after this 15% surge.
But the hard evidence from our stress test shows a company that's struggling with anemic organic growth, collapsing real-world profitability, and a deeply inefficient use of its investments. The blueprint for their skyscraper is exciting, I'll give them that, but the foundation shows some very serious cracks. So the ultimate question for any investor looking at this stock now is this. After such a massive run-up in the price, is the price of admission for that AI dream simply too high to ignore the very real weaknesses in the structure today?
And that's for you to decide. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.